AI stocks are wobbling. Amazon's potential 10 billion US dollar deal with OpenAI has tongues wagging. Oracle's mystery Michigan backer keeps everyone guessing, and credit fears are spiking. Happily, Micron surpassed expectations yesterday after the bell, reminding those who need to hear that AI demand remains intact. But anyway, all eyes will be on today's CPI data from the US for Fed clues, along with a likely unchanged ECB policy and a likely Bank of England rate cut. So welcome. You are watching Swissquote's Daily Market Talk. We are December 18th. I'm İpek Özkardeşkaya. And everything I will be saying in this video are based on my own opinions. And this is, of course, not financial advice. So the market sentiment is not great after Tuesday's US jobs data failed to fuel optimism on more Federal Reserve cuts next year, and AI sell-off got worse yesterday on the back of two major news that rubbed salt on the circularity and leverage debt wound of investors. First, Amazon is in talks for investing 10 billion US dollars in OpenAI. In return, OpenAI would buy Amazon's homegrown Trainium chips. The same circular type of deal that OpenAI recently contracted with Nvidia probably, that raised a lot of questions, remember, about the circular economy around these AI investments, the contagion risks that come along with these, and was pretty much the beginning of the waning AI appetite. And second, Oracle said that negotiations for an equity deal for a data center project in Michigan didn't include Blue Owl Capital, but that their development partner chose the best equity partner from a competitive group of options without saying who that best equity partner was. So the suspense is forcing investors to rethink on who is actually backing this project and how secure the funding really is, especially given how high the credit default swaps are spiking for Oracle these days, suggesting the rising fear of default that investors attribute to overly leveraged Oracle for its massive data center projects, of which one had got delayed due to labor and material shortages very recently, remember. So the result is another 5% drop in Oracle's share price, bringing the total loss since September peak to 45%. Nvidia lost 3.80% yesterday. The reaction to Amazon was not brilliant either. The share price was down by 0.58%. Quite disappointing when you think that the news that Meta would buy Google's TPUs had sent Google high up to the skies just a few weeks ago. And even Google, that's not in the OpenAI Nvidia circle, lost more than 3% yesterday. So I'm thinking, it is maybe happening. The AI bubble is maybe finally deflating. How bad the sell-off will be if that's the case is yet to be seen. The valuations are sky high enough actually to justify a 10 to 20% sell-off from peak to trough on index level. So in that context, Nasdaq could dive to just below 21,000 mark. I know it's not what we dreamed of for the season finale of such a strong year, but that's a possibility. Good news is that Micron's earnings came to lift sentiment among tech investors yesterday after the bell, with both revenue and profits there beating analyst forecasts as demand for memory used in data centers and AI applications stayed strong. The numbers confirm that the recovery in memory cycle is gaining traction indeed, helped by tight supply and rising prices, reassuring investors out there that Micron is benefiting directly from the AI spending boom. So Nasdaq futures are in the positive this morning. At the time I'm talking here, as attention shifts from technology to economic data again this Thursday, with the US preparing to reveal the first set of CPI data since the US government shutdown. Finally. Of course, as an economist, I can't stop thinking that today's inflation data should play a key role in the forming of Fed expectations, especially given that inflation remains sticky and above the Federal Reserve's official 2% monetary policy target. And I keep thinking that the Fed could not cut the interest rates to, I don't know, to 1% for example, as would be desired by Donald Trump, without the risk of inflation spiking to painful levels for Main Street people. Normally, the weakening jobs market should tame inflation, mind you, because people spend less when they earn less because they don't have jobs anymore. But then there is the tariff story that makes this jobs to inflation equation quite uncertain. Uncertain because if the tariff-led inflation kicks in, if it ever does obviously, the demand pullback from people should be strong enough to keep inflation in check. And for that, the demand pullback to be strong enough, jobs market should be severely hit. And that's exactly why markets have been more focused and reacting more to the US jobs data recently than to the inflation data. But the fact that the jobs data in the US is weakening but not collapsing, so the resilience of this US jobs data could shift attention back to inflation. So the interpretation of inflation data is quite straightforward. A soft set of data should keep the Federal Reserve cut bets in place and give support to equities, bonds, and weigh on the US dollar, while stronger than expected figures would put the dovish Fed plans at jeopardy, weigh on equities and bonds, and support the US dollar. Right now, the US dollar is slightly better bid into the US CPI data of later today. The euro dollar is flat and cable is under pressure into the European Central Bank and the Bank of England decisions, both due today. The ECB is expected to maintain its rates unchanged today. And the ECB chief Christine Lagarde will likely reiterate that the European Central Bank's monetary policy and rates are at a good place today, and that the committee will continue to monitor the economic data closely to decide what to do next. The base case scenario here is that the European Central Bank remains pat today and also next year. Across the channel, the Bank of England is facing a more difficult picture, however. The UK's economy is suffocating, if you didn't notice, with budget measures and job losses that hint at further deterioration of the budget. So it's a very, very bad circle to be in. Then the productivity gains are pitiful and the growth outlook remains quite bleak. So what held the Bank of England from cutting the interest rates this year was inflation, too high inflation, but finally and happily the inflation fever seems to be breaking for the UK. Yesterday's data came in as a rare surprise to UK's inflation dynamics since a while. Price pressures, however, remain above the Bank of England's policy target, currently a bit above the 3% mark, but is expected to head toward the 2% target by next spring. So the Bank of England will likely cut the interest rates today and should more likely than not deliver a dovish accompanying statement for next year that should in return keep sterling under pressure. So if we summarize, the Fed's dovish pricing will be put to test with today's CPI numbers. The European Central Bank will have nothing crunchy to offer today, while the Bank of England has a better chance of coming out more dovish than maybe priced in which case the US dollar could further rebound. Sterling would remain under a decent selling pressure against the euro and the US dollar, while the euro itself would follow the lead of its major peers. Then tomorrow, the Bank of Japan will close the dance with a widely expected and priced-in rate hike. The Japanese 10-year yield is just below the 2% mark, also pressuring other DM yields higher, which also doesn't help with the overall risk sentiment. Happily, the Federal Reserve's repo purchases are rising these days, giving risk investors at least some comfort. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.